Hello, everyone, and welcome to BFW 2401, week 6, part 2. Now, as we talked in part 1 about the liquidity risk, now here we are actually talking about liquidity and liability management, which is actually in chapter 15 on the recommended book. Now, I want to cover the following. First of all, the concept is like this. If we have liquidity and we want to be sure that we can secure enough sources to manage our liquidity requirements on time, then we have to look actually to our liability side, because the liquidity actually is created from the liability side. In other words, if I have demand deposits, those ones have high liquidity requirement. But if I have certificate of deposits, it's different. The problem is when you build this portfolio of liability, you have to understand that you have a trade-off. And that trade-off is if you want to have less required, less liability items that require less liquidity, then you have to sacrifice the return. The same thing if you want to have higher returns, then you will have to deal with those type of liabilities that requires more. For example, when you take what we call retail deposits, those ones actually you pay for them less, but they have the behavior of the withdrawal is much, much higher than the certificate of deposits. So the concept I want to talk about here, which is the first concept, is the trade-off between return and risk. When we say risk, the risk of liquidity. The second thing we want to talk about the structure of liabilities. If we already know this trade-off issue, now we will go to the structure of liabilities. What consists and what structure that the bank has in its liability portfolio. We will see all the items and we will define them. Actually, this is the things that I wanted to cover mainly in this part. And if you allow me, let me now share my slides. And hopefully I will not take a long time here. I take almost an hour and something in the first part. Okay. So let me just share. Okay, so we are talking here about the second part. And as I told you, it's liability and liquidity management. And as actually we are talking here in week, basically we are talking about week 15. Okay, if we understand this, now we go to, this is just another repeating slide. And this is my agenda. We will talk about the introduction. We will talk about the source of liquidity, where we can get it. We talked about it in the first part, but here we will just actually go in details. We will talk about the composition of this portfolio of liabilities, of liquid assets. And the most important issue is actually the return risk trade-off, which I want you to be introduced to in this part. And we will talk then about the liability management, and we'll talk about the structure, which means how many items we have in this portfolio. Every single item inside that portfolio, which means the liability portfolio, has different characteristics, and it has different impact on our liquidity risk and liquidity requirements. We'll talk about deposit liabilities and non-deposit liabilities. And we will talk about some issue that happened after the financial crisis when they introduced some scheme called deposit protection scheme. Now, deposit protection scheme now is applied almost in all those countries, including Malaysia and Australia and the US, where we are actually guaranteed up to 250,000 ringgits or dollars. If you are in the US, here 250,000 ringgits that the government will pay us. Actually, part of this, it's not the government, it's an agency an insurance agency supervised by the Bank Nigara militia here. PIDM, they call it PIDM. Those PIDM, if there is any stress for any banks and the bank is liquidated, they will pay us up to 250,000. I mean, they will cover up to 250,000, which means we don't have to go for bank run. This is one of the treatments and the remedies for this liquidity problem. Okay, so let me go now to historically, we keep talking about stored liquidity, which actually is selling our assets and cash to finance or to satisfy our unexpected withdrawals or the liquidity risk. But that actually is a long time and it's old practice. Now, what we are talking about is liability liquidity, which means the purchase liquidity. This is what actually banks are doing now. Now, what is the asset liquidity? We already talked about it. Either we can have cash or we can have securities that can be transferred to cash very fast, called treasury securities, or we can have a certificate of deposits that as an asset. And this we can trade it in one day, in the same day. We can hold it for 1 year, but we can sell it to another investors in the market. This we can return it to the central bank or sell it to somebody else, and this is already cash. Now, what about liability liquidity, which is the purchase liquidity? This one, we can have interbank, as I told you. We can have this agreement with the government called repos, which means we can sell our securities and buy it later on. Central bank provide this facility. And we can have also the interbank market. This is different from this one. This you borrow from the interbank market, but this is only through the settlement, what you call it, which is the exchange settlement funds, which is actually a type of accounts held by the central bank for all banks. So banks borrow from each other in that account. This is you go directly to the interbank market. Okay, measuring stored liquidity is difficult actually because you have to make real expectation and forecasting. If you have those type of securities, you don't know how much actually cash you will have because it's almost random behavior of withdrawals and additions. And if you want to expect how much actually cash you will have in 1 year time, it's actually a little bit difficult. The other thing is, if you have those securities and you want to liquidate them and you want to see how much they will give you later on, this is also another difficult issue because you don't know what is the status in the market when you sell those assets. So it's a little bit, difficult actually to predict, but we use this, what you call normal distributions, as I will show you later on, to measure liquidity. Now, stock of liquid assets and financial institution depends on our willingness to trade off, which means either we can have more cash and more short-term securities, but that will be on the expense of the returns. Or we can have long-term in liquid assets, and it will give us long-term, like housing loans and other business loans that will stay for 3 to 5 years, but they will give us 12% and 15%. If you want to keep the same money for very short term, they will not even give you 1%. So you want more return, there will be more risk. You want less return, there will be less risk. This is what we mean by that trade-off. And I want you actually to be aware of this concept in this context. Now, there is no tradition. There are also some non-traditional ways of obtaining liquidity, which we already know. Securitization, where we can sell all our loans and to a special purpose vehicle who will sell it to investors. And at the same time, you can exchange those illiquid assets of loans with cash. This is how to get more liquidity. The other thing is you can actually increase your yield. You can go and take, especially if you have access to the market, you can go and sell, invest in long-term loans, business loans, housing loans, some type of other loans that will be for a long time, or even invest in bonds and fixed income long-term securities like bonds, 20 years, 30 years. This will give you 7 and 8%. But in the same time, you go and when you need liquidity, go and borrow from the market. You will borrow with higher funds, with higher cost of funds. And that's fine because you already receive higher returns. And if you receive, liquidity, arises or emerged in any time, then you can go and borrow from the market with higher rates, but you're already receiving higher return. So this is what we mean. And you can also use the capital market, which means you can issue money and capital markets instruments. Actually, you can issue capital market instruments. You mean anything more than 1 year. You can also use issue commercial papers, certificate deposits, bonds, and others. Okay. Liquid assets are traded in a deep market. Maybe this is some of the concepts that you are not aware of in this stage. It's an investment terms. When we say deep market, when we say this market is deep or there is a depth in this market, we say this market is deep market. This market is a shallow market. Now, when we mean by deep, which means the trading is too much. The trading, you have intraday, you have daily, so you have too much trading. So when you buy securities, it's easy to sell them. But when you have shallow markets, which means the buying and selling of the securities is not, is not as frequent as the deep markets. That's what we mean. So when we talk, and then the context of liquidity, it's better if you are investing in securities to be in a deep market, because that depth in the market will allow you to sell, which means depth market is actually, you can see the trading of any security in the market is repeating and high frequent, and it can also be in large volumes. Now, the even large trading volumes will not impact on the price, as I told you, because the spread will be less. And when we say depth market, deep market, actually we are talking a market that is very liquid. Now, liquid assets include treasury notes and treasury bonds. And this is, as you can see, government securities with fixed income. And those ones, you can transfer them easy to cash, especially if the central bank opens what you call discount them for you when they have open window discounting. So you can sell them to the central bank or in the market easy. Now, liquid securities carry a comparatively low interest rate. Because they are short term, and like the government will give you 1 to 1.5% or 2% now maximum in this country, but they are liquid. You can sell them. They bring interest rates, low interest rate, and this is actually you avoid the risk of liquidity, but actually you compromise the return. So here we have what we call risk-return trade-off. Low levels of liquidity expose financial institution to enhance liquidity and withdraw run risks. This is we already know. So if you have less level of liquidity, that will make you very illiquid, which means you cannot manage your liquidity requirements, and you cannot have liquid assets when you need them. And if this if the situation happens and we cannot manage it on time, and depositors hear about this, and then that news spread around that you are under stress of liquidity, you expect a bank run. And this is a big problem. Liquidity requirements are set to lessen the following risks. So decreased risk run on banks. It also depends on the reserve requirements. If the reserve requirements is less, so in this case, you have more liquid assets. So in this country, we have 4%. I think it's 5% by now. If you have a countries like Japan, 0. So you have actually more room to keep as liquidity. But if the reserve like Brazil and some countries in South America of 30%, 40%, then in this case, all of your liquidity is actually in the reserve in the central bank. There is also taxation implication. If you have, the government will take those reserves and pay you either very, very minimal or they pay you 0. So actually, it's like another type of taxing of tax. So the government will take all those resources and pay you nothing. And you have to pay actually return for your depositors. So the government will take this under reserve. So it's actually a type of taxation that is not actually indirect taxation. So this liquid asset requirement depends on those ones. If you have less reserves, of course, you will have more liquid assets because you will avoid money kept as reserves to the central banks, and you will avoid this taxation problem. Now, the composition of liquid asset portfolio is determined by two things. Earning consideration, now we are coming back to the trade-off. Earning consideration or liquidity and liquidity regulations. So let's talk about the earning considerations. So as I told you, short-term type of assets that can be liquidated anytime. This will be on the expense of the returns that you can get for the same money if you invest it in long term. So it's a trade-off here. Number two is the regulations. Sometimes even if you can manage number one, still the regulators want you to keep 8% or 9% or 5%. I think I talked about this in the explanatory video, but if you didn't watch it, it's just for example, Basel will ask you for 2 ratios, and you have to keep that if you want to comply. And also all those governments have their own local regulations for what percentages the liquidity should have. So actually, it's not in my hand now how much liquidity I should have or how much short-term assets I should have. It's also governed by the regulations. The earning considerations also is another issue. So historically, many countries has imposed liquid asset ratios. Like Malaysia, as I told you, the 5% buckets. In Australia, we are talking about 8 or 9% for banks who don't have system for liquidity. Number two, government securities act as a secondary reserve. So actually, sometimes you can hold government securities. The reserve for the central bank can be either in cash or can be in government securities. Now, when we say government securities, means you receive some type of return. So in Australia, they are very flexible. I don't think, according to the book, the US are not very flexible in this issue, which means they need only cash. But in Australia, you can have government securities like T-bonds or T-notes for the reserves. Managing in the securities portfolio, which is the asset, is an integral part of liquidity management for financial institutions. So the conflict, we come back to this risk return issue. So the conflict between Balance of risk of liquidity and desire to maintain high investment return is the heart of management of the liquid asset portfolio. So when you have liquid asset portfolio, you have to see to long-term and short-term, and all these portfolio depends on actually the risk and the return. So the trade-off, the benefits and cost of holding liquid assets. So there is a trade-off. So cash immediacy versus reduced returns. So the determinants of a financial institution optimal liquid assets actually depends on the following factors. And let's talk about those factors briefly. We talk about the the volatility of this, volatility and variability of deposit inflows and outflows. It's not steady. For example, if you are calculating the cash additions and the deposit additions against the additions, the deposit withdrawals, one of them is cash inflow, the other one is cash outflow. If it is not stable and there is high volatility in that, so in this case, that will lead you to have to reserve more liquidity, more liquid assets, because you don't know when you will be stuck, okay? So yield to non-liquid assets, which means if the yield is very high for long term, you will just go and invest, and in the same time, manage to get short-term liabilities if you need liquidity. So this will actually, if the yield is high, high yield will actually decrease your liquidity decrease your liquidity holdings in the short term. This one, the volatility I told you, will lead you to actually increase also the liquidity, increase the liquidity. Here, decrease the liquidity in the short term. Then also the liquidation. If you are actually living in a very liquid market and there is high volume of trading and the market is very liquid, so in this case, the spread is less. So there is no worries if you hold, this portfolio of assets and you can liquidate them very fast. But if the liquidation is very hard, then actually you will tend to hold more cash that will expose you to less fire sale and less what we call spread between the buying and selling. So you can sell close to the market price. Now, if there is higher interest rate paid on purchased liquidity, that will actually not encourage you to have less liquidity, but you will have more short-term assets because they are cheaper for you. Because if you decide to invest them in long-term assets, and then one way or the other, you need to borrow, go for purchase liquidity, and it's very expensive, then the actually, investing your short-term assets on long-term liability may not give you the desired payoff. This is what we are talking about, the interest rates. This is just about Australia. In 1998, Australia actually provides so many facilities to manage. So we can talk about all of those. This is actually the payment system that will help the interbanks to settle their dues. For example, if there is, because there is checks going around the banks, payments are going through the banks from customer to customer, and those customers are coming from different banks. And for example, if I write a check now for 50 million ringgit, and I am a public bank customer to somebody who is in Maybank. So now Maybank is the transaction between us as customers, we will settle. Yeah, I am a public bank, you are May Bank, 50 million, you receive it, you give me the assets, maybe you know, some type of cargo or you know, big purchase of land or you know, housing area or whatever. And in this case, you will settle it, you will bring it to your bank, and it will be you know, transferred to your account. But end of the day, there must be a settlement between Maybank and public bank, which means Maybank has to take the 50 million from public bank because it's already recorded for his customer. And in this case, there is what we call settlement accounts in the central bank where they can settle that one. The other thing is just as easy as this. If the ATM machine, if I am HSBC now customer, and I go to Monash downstairs and I withdraw money from the Maybank ATM machine, which will allow me, end of the day, this money belongs to Maybank, but the withdrawal was by HSBC, which is I am as a customer. Now, in this case, my transaction of, say, I withdraw 500 ringgits had to be settled end of the day in the central bank, where HSBC has to pay Maybank the 500 I withdraw. I am a HSBC customer. So to make it clear, I want to just to be aware of this exchange settlement account. We have it everywhere, and it is related to liquidity because you have to have always funds in this account, which is held by the central bank. And if you don't have enough account, you are under what we call liquidity risk. Now, this is the daily transaction that is happening every day, okay? So those daily transactions, you have, for example, Bank A, Bank B, Bank C, and Bank D. So Alpha, so this is maybe public bank, this is maybe Maybank, this is maybe HSBC, maybe this is, you know, Hong Leong Bank. So now the customers, there's so many customers in the market working, those institutions help them. If a customer of Bank Delta, say Hong Leong, for example, wrote a check for customer A and Bank Charlie, which is CIMB. Now, just assuming, now in this case, there is a liquidity problem because Bank Delta, Bank Charlie or C has to take the money from Bank Delta end of the day because his customer actually paid to his customer to customer one and Bank C, and Bank C already credited the amount to his account, but he has to receive it also from Bank Delta end of the day. This is how the what we call the settlement end of the day happens. The same thing you have, for example, Bank C customer wrote a check for Bank B, a customer in Bank B, for 10 million. Now, Bank B will will credit the amount of the withdrawal to his account. But at the end of the day, Bank B has to go and ask from Bank C the amount of this 10 million. Because it's recorded here, but has to be received from Bank C. Now, Bank C, when he give you the 10 million, of course, he will debit his account, his customer, which is customer 2. So he will detect it from his account, add it to you, where you added your customer number 1. Now look for Bank Alpha. Here there is liquidity problem, as I told you. Here there is a liquidity problem. Here there is no liquidity problem. Because if I am a public bank, and you are a public bank, and I transfer for you now 10 million ringgit as a business, there is no impact because the liquidity is still the same. It doesn't leave the bank. It's just from customer A to customer B, or customer 1 to customer 2 to customer 1. That's it. So this is why banks are crazy to get as many as they can from the depositors. One of the reasons is to manage liquidity, because all those transactions inside the market will be as they are working in the same pool, in the same bank. Yeah, but when you are a small bank and you have so many, your customers are writing checks for everyone around here. So this money will be asked from you end of the day. And if you don't have money in this, what we call exchange settlement account, there is a problem. Okay. Now this is some information and about the ECA, as I told you, and it can be intraday purchase agreement facilities, and they can settle it overnight repurchase agreements. So this is the ACA are clearing accounts, must be kept in credit all the time, which means your account. They charge around 20 basis points interest on surplus balances if you have surplus in your account, because every single bank has account in the central bank and the what you call exchange settlement account. And in the day when they do the transactions, some accounts, some banks have surplus, some banks has minor deficit, so they settle these amounts. And if you have surplus, they will give you 0.25 basis points. If you are minus, then they will cover your dues and they will charge you 20 basis points, and this is only overnight. Okay, in case of urgent liquidity needs, financial institution can use the following exchange settlement liquidity sources, what we call intraday repurchase agreement. They can do it with the central bank, or they can take the overnight repurchase agreement. They have two types of repurchase agreements for the securities. So this is just to intraday or overnight. Okay. Now this is another issue which we talked when we talked about it, of the trade-off, and I want you to be aware of this one. If I have a CD, which is certificate of deposits, if you issue it today, it will stay for 1 year. And the buyer of your CD, for example, you issue a CD of 1 million, the buyer will give you the 1 million, and the maturity of this CD is 1 year, for example. So they will not withdraw the money from you before 1 year goes, but they can trade it in the market. The problem is when you issue CDs to customers, you have to, it's high charge. It's actually according to the market rate, and the interest is high. But the liquidity withdrawal is almost none, because it's only after 1 year, unless you decide to discount it. But the customer who will buy it, he doesn't have to go back to you. He can sell it to another customer, discount it to another investor, another investor to, investor two, investor one to investor two, investor two, so investor two to investor three. All these trading happening with this CD, and they don't have to come to you as an issuer. Now, just take this one. This is, as I told you, expensive. But when we talk about demand deposits, you pay them now how much? They less than 1% and something. But the behavior of withdrawal of the demand, those either saving accounts or current accounts, they withdraw their money on frequent basis, and their withdrawal is very frequent. So they have higher liquidity risk or higher risk of withdrawal, but they are very cheap to keep them, very cheap. See, this is the cost, the funding cost, very cheap. Here, the funding cost is high, but the risk is less. This is the risk, the axis. The x-axis is actually the risk, and the y-axis is actually the cost. Now, let me move to this. This is actually very interesting, because this is when I talk to you about the liabilities structure. This is actually the 9 areas. You can raise funds from those 9 sources. You can build your portfolio, deposit, a liability portfolio based on this. Some of them short-term, some of them long-term, and every single item of this has different characteristics. So you have current deposits. This is high degree. Think about it from a liquidity issue and from their cost. They are higher degree of withdrawal risk, but they are low cost. This is like current deposits. Interest-bearing check accounts, same thing, low degree of withdrawal, but they have implicit interest. You pay for this. Here you don't pay interest, or you pay very low. Saving account is mine and you and everybody who's opening accounts, usually in this country. They are strictly stable, less liquid than check, than this one, but allow fund transfer. I can transfer my saving accounts to others through ATM machines. And major cost is the explicit interest payments, which means how much they pay us. We have term deposits, and term deposit, this will stay for 90 days, 180 days, 270 days. And actually maturity generally between, and some of them between 1 year and 5 years. We have also very short term of them, but the term deposit can be also from, as I told you, from 1 month to 5 years. As we know, we have 90 days, we have 180 days, we have 270, I think 1 year, 2 years, and 5 years. So they are attractive in times of decreasing interest rate because they will give you fixed interest rates. And the major cost is the interest you pay for them. Certificate of deposit, we have two. We have retail. This is very, very good in terms of the withdrawal. There is no withdrawal, actually. They have fixed maturities, and future value could be less than 100,000. This is the retail ones. They have low withdrawal. As I told you, you can withdraw it before 1 year if it is for 1 year. And it can take from 14 to 270 days, as I told you. So they have low withdrawal risks with early withdrawal penalties. A major cost is explicit interest, which is how much you give them interest. And you have the same thing, but this is for any certificate over 100,000. So actually, it's the same characteristics, but the withdrawal is very less. Now you can go to the interbank and borrow from the interbank, and it's short-term and consolidated and collateralized loan between financial institutions. The cost is a short-term money market. You can roll them over. And then we have repurchase agreement. This is when you sell your securities to the central bank, and you can get money from them. So, and for example, if I am in need for liquidity, I can discount all my securities like T-bonds, treasury bonds or treasury securities, short-term, long-term, sell it to the central bank today. Central bank is not actually interested in it, but they can keep it with them. So they discount it today and they give it back to you, and you have to buy it back after 1 month or 2 months or whatever, depends on when you solve your liquidity problem. And the difference between the buying and selling is what the central bank will do. So they are highly liquid and flexible, but yields below market interest bank rates. Of course, when you buy those securities, it's easy for them to trade them or discount them, but I told you the return of those government securities is very less. Now we have also, we talked about that this is covered bonds, and this is like the MBP, which we talked about it, mortgage-backed securities. When you issue bonds when you issue bonds and you collect investors' money based on backed securities. So you issue backed securities by the loans, and you can sell them as bonds, and they are guaranteed by your assets. Then we have other borrowings. We have bill acceptance. This is mostly short-term bill acceptance, commercial papers. You can issue subordinated net debt, which means they are debt here that can be changed to equities. But all of those actually source of liquidities. Now, all of those have different costs, and they have different liability, different cost, and actually have different withdrawal risks. When you build your portfolio liability, the portfolio of those, which one, how can you, structure your liability portfolio depends actually on what you desire, on the cost benefit, the cost return trade-off. And of course, you can build simulations and you reach the optimum compensation structure of all those type of liabilities. But this is just to give you the structure of liabilities, and please understand them. So if we go to this slide and this slide and this slide, just explaining what I have said. So if you wanted to know more about deposits, it's just what I said here. Interest bearing, they will tell you a lot about it here. It's the same thing I just explained now. And now let me go to the next stage, which is the liquidity regulations. We have this regulation, international regulation, which is coming through Basel. Basel is requiring to those LCR and NSFR. You are not required in this class to calculate them, just to know them from generally. But we have also in Australia ABS 210, and I'm not really interested to test you in regulation in this stage. I just want you to know that in Australia ABS 210 govern liquidity. As in this country, we have the buckets, but here is more extensive regulation for liquidity. And they tell the banks, look, either you have system, and this system has to have liquidity management systems that address you have the system that builds scenarios and address the going concern scenario and predict normal liquidity. So they know that you have a very, very concrete system to manage your liquidity. And this system also have to take into consideration the contingency plans. So they know that the system is actually accurate and effective in dealing with security. And in this case, they will not ask you, this is the regulation in Syria, they will not ask you for any percentage of liquid ratio. So liquid ratio is not required here as long as you show them that you have actually a concrete system in place. If you don't have that for small banks, they will ask you to keep 9%. So this is the essence of ABS 210, and actually I am not going to ask you questions about the ABS 210 regulation in this stage. Okay, this is called Basel. This is very interesting, and I want you to be aware of it. This is what we call the deposit insurance. Deposit insurance was introduced after 2008. And the purpose of deposit insurance is to tell customers and depositors, if anything happens, don't run. That's what they want to say. We as government, we will pay you your amounts up to 250,000. So if I have 10,000, they will pay me. 20, they will pay me. 200, they will pay me. Until 250,000, the government is actually will be able to pay me. And this is the banks do what we call, they pay premium. For example, in Malaysia, we use PIDM. And Australia, you have the Federal Deposit Insurance Corporation, FDIC. So these people are actually governed and supervised by the regulators, and they receive premiums from the banks, and they can insure them in terms of liquidity that they will pay up to 250,000 for each customer, and this is actually to decrease the bank run. So the system is actually so if there is a problem, you don't have to run. It's your money will come back to you as long as you have less than 250,000. They also introduce another schemes for businesses. Please note, this is a guarantee scheme for large deposits, I think up to 1 million. This is the 250,000, as I told you, in Australia. I think So this is the as I told you, the Australian system. I just want you to know that we will not go on details here. We'll just tell you that you have to understand that there is what we call this protection coming from the deposit insurance scheme, and actually the purpose of it is to decrease the risks, bank run. This is details, you can read about it. Now maybe this is the only calculation here, which is when we want to see how much each customer cost us. For example, look, this is calculation of implicit interest rate. We have explicit and implicit. So if you have a customer, if the cost is 150, the Brazilian institution average management cost per account. Each account, of course, my account has a cost, your account has cost, because you use the ATM machines, you use the all those facilities, you use the internet banking. They send you sometimes all those statements. Sometimes they charge you, sometimes they don't charge you. So if the average management cost per account is 150, if the average fees end, sometimes is 100, and the average annual size of account is 1,200. So they will pay you actually what we call implicit interest rate, IIR, how much actually you cost them. So you cost them 150 minus the 100, which is the average fees. And this is actually your cost, which is 50 over 1,200. So this is the fees you pay. This is what you cost them. End of the day, they pay you the average management cost minus the average fees collected from you. So actually, it's 50, and you divide it by the 100, the average annual size of your account. This is 4.166. This is how much you cost the bank. This is how much you cost the bank actually. You cannot say they don't pay you interest, but they think the service is actually a cost for them. You pay also just part of this service, and this is how much you cost them. Okay, you can also go to these calculations, and it's the same thing. So they pay you if you have, for example, 250. If consider a depository institution who hold average 250 per month for the first 3 months, this is a customer, and 500 for the next 3 months, and 1,000 for the final 6 months. This is almost 12 months now. It's always 12 months. The account pays 5% per annum if the minimum account is 500 or more, and pays no interest if the account less than 500. The depositors makes an average of 50 international transactions per month and pays a service fee of 1 cent for each transaction. Although it costs the bank 15 cents, you pay only 1 cent. To process the transaction, this account holder goes gross interest return consisting of implicit plus explicit interest. Let's calculate it. So the gross interest return is explicit interest plus implicit interest. So they pay you 500 and pay 5%, and you have only 500 for 3 months. So this is the first 3 months, how much they cost you, and this is the next 6 months. See, 25. This is 50. This is the second 6 months, because they don't pay you for the first 3 months because you have only 250. So this is when you keep 500. This is when you keep 500 for 3 months. This is when you keep 1,000 for 6 months. And this is the fees. Actually, you make 50 transactions. You pay only 1 cent and they pay you 15. So actually this is their cost. So times 12. So actually this is what they pay you as an explicit interest. And this is what they pay you as, as fees. So actually it's 61.25. This is the implicit and explicit interest rate. Now you can go here, it's the same thing. We just change, suppose that the minimum balance sheet lowered from 500 to 50 to 250, which means I will give you 250 for the first of the 3 months. It's the same thing. And the second 3 months. And this is for the 6 months. And then this is the fees. And this is what you cost, 94.38. This is the only calculation for liabilities, but the most important things in liabilities is actually how you structure this one. It's a very, very big, you have to consider the cost and the return and when you construct the portfolio for liability. And as I told you, the most important thing is to get a liability portfolio that will serve you, serve the cost benefit analysis, a cost return, and also will help you in managing your liquidity. I'm done for this part. I hope I didn't take a long time. Thank you very much. I will not take more time. Happy day wherever you are. Bye-bye.